The Super Bowl is over, which means it's tax time on the Capital Stewards Podcast. In this annual episode, we're going to talk about turning the dial on smaller opportunities as you go through preparing your taxes for last year, your 2024 taxes here at the beginning of 2025. We'll talk about moving the needle on larger long-term tax planning strategies that you can start implementing this year to generate really big savings down the road. And then lastly, because the Trump tax cuts expire at year end, I'll share my view on tax policy potential changes, including what your fair share of the tax burden is and things you need to watch out for as we head through the end of this year, because there might be more volatility in kind of the tax regime this year than in some prior years. But before we dive into all of that, just like we normally do on this episode, let's talk about some Super Bowl ads. I thought this year's ads were better than last year. Maybe that's an outlier opinion. I don't know. I've seen them widely panned, but I thought they were pretty good. Perhaps a comeback this year for more traditional categories like trucks and beer. I think my winner for best ad goes to Ram Trucks with the Goldilocks and the Three Bears ad. I thought that was funny. My kids thought it was funny. Everybody thought it was funny. Perhaps second place goes to Budweiser with two hits. One, the Clydesdale horse delivering the left behind keg, kind of tugging on the heartstrings. And then, of course, the famed cul-de-sac party ad with beer being shot out of, leaf blowers, Peyton Manning wearing a fanny pack. I mean, really all the things that you want to see in a beer ad, right? So honorable mention goes to Hellman's mayonnaise because, as they say, it always hits the spot. And my vote for the worst ad this year, which goes to the one that I think makes the least business sense, the one I just don't understand, was Pfizer's ad, which I thought was essentially just PR for the company. That seems like an expensive use of their capital. It wasn't particularly memorable. It left me wondering what I was supposed to think about them after I sort of watched the game. So just like last year, I'll put links to all these in the notes to the show. They'll also be on the blog post on our webpage when that goes live. So you can check them out if you haven't had a chance to see those. All right, so now the Super Bowl is over. It's time for spring training, baseball season, my favorite time of the year, and of course, taxes. Before we dive into strategies and ideas to reduce your 2024 taxes, I want you to remember that tax reduction is a long-term game. Smart tax planning is not about an annual hunt for deductions. That's even more true now than ever because the Trump tax cuts from his first administration, the Tax Cuts and Jobs Act, increased the standard deduction, removed many of the more common itemized deductions that you hunted for every year, and they simplified the tax code. So that deduction hunt isn't likely to be super fruitful on an annual basis. The best way to minimize your taxes are through longer term strategies like investing in the right types of accounts. So think retirement accounts, IRAs, Roths, 401ks, structuring your business entities appropriately. So whether you're in a sole proprietorship, an S Corp, a partnership, and then managing your taxable income each year and doing that effectively over many years. So if your tax planning is sort of an annual thing that you do in March for a couple of weeks, I'd consider working with your CPA or financial advisor to create a more efficient long-term tax plan. That's something we do with clients. We'd be happy to help you with that. So more on those longer term strategies in a few minutes. We're going to dive into those and spend some time there. But let's start with what's probably top of mind for you, which is considering how to turn the dial a bit to reduce those 2020 taxes. So before we start looking for deductions, which I think is where everybody starts, we should actually back up and let's look for opportunities to reduce your top line taxable income. And here are two strategies I think that could help you do that, and these can be used fairly widely, so certainly things you should consider. The first is opening a health savings account. If you have material medical expenses, which is virtually everybody, then an HSA or health savings account is a great way to reduce your long-term tax liability. These accounts receive what I call the trifecta of deductions. The contributions are tax deductible, the account grows tax-free, and then distributions for healthcare expenses and some Medicare premiums are not taxed. So a lot more people should have these than do currently. Even if your medical expenses aren't higher than 7.5% of your income, an HSA still can be a really good tax reduction strategy. Even if you're really healthy now, you can put money in there and you can use it down the road when your family has higher medical expenses, when you have kids, or later in your own life when inevitably everyone has higher medical expenses as they get in their 60s and beyond. So consider opening an HSA. You can open one and contribute until April 15th and categorize it as a deduction for last year or a reduction in income from last year. So think about that. Retirement account contributions. You have until the April tax deadline, so April 15th this year, to contribute to retirement accounts for last year. So if your income is relatively high in 2024, consider making IRA contributions to receive the tax deduction now. However, I caution against doing this blindly every year. I call that maxing out your taxes by maxing out your 401k and your IRA. If your 2024 income was lower than usual, then you should think about paying the taxes now, getting preferred capital gains treatment on future investment gains. Also lower income years are really good opportunities for Roth conversions or making Roth contributions. So the right answer might not be let's reduce our taxes this year. If your income was lower last year, it might be let's reduce our taxes down the road by paying some taxes now. So you have to be really thoughtful about how you plan for that. All right, so once we've reduced our income as much as possible, then it's time to look for deductions and credits to offset taxes where we can come up with them. So here are 4 opportunities to help you offset some of your income from last year. The first is the child tax credit and don't forget summer camp. If you have children, you're eligible for a credit of up to $2,000 until your income reaches $400,000, or half that if you're single. Additionally, you can receive a credit for daycare, household help, even day camps where your children don't stay overnight. So if you send your kids there in the summer, you can still get a deduction for about 30% of your expenses up to $3,000 for one child or $6,000 if you have more than one child. So there's a nice healthy deduction for you there. So don't forget those summer camp expenses or your child care expenses, even things you might not think of as traditional child care might count for additional credit in the child tax department. Home mortgage interest. Home mortgage interest is one of the few deductions that remain after the tax law changes in 2017. Just remember, interest is only deductible on balances below $750,000, which didn't used to be an issue for lots of people, but as home prices have risen, particularly in large metro areas, more homes are now crossing that threshold. The good news is if you bought your house before 2018, you're grandfathered into the old $1 million limit. And if you bought your house and now it's worth $750,000, but it was worth less than that when you bought it, then your mortgage balance is still below $750,000. So you're in good shape. So just be mindful of that limit if you've bought a house in the last couple of years. The home office deduction. If you work from home as a requirement, not by your own choice, for your employer, then you might be eligible to deduct the cost of your home office. That includes things like prorated portions of your mortgage, interest, utility bills, depreciation, all that based on the size of your office. My cautionary note here is that a lot of folks work from home occasionally by choice. That does not count. So just because you have some flexibility now in this sort of post-COVID world and you work from home a few days a week, that doesn't allow you to deduct your home office. You've got to own a business, so good opportunity for business owners here, or your employer has to say, hey, you work from home, you don't have another office anywhere else. In order for you to be able to deduct your home office, you need to be fully remote, something similar to that. Otherwise, the IRS will come back and say, hey, you can't take that deduction if you're just choosing to stay home a couple of days a week. Long-term care insurance. Folks often forget about this, but long-term care insurance premiums can be deductible as medical expenses if your total medical expenses are larger than 7.5% of your adjusted gross income. So you got to have a lot of medical expenses. But if you get up into that category, you can deduct those long-term care insurance premiums as medical expenses as well. So check with your CPA if you've got long-term care insurance and you had a lot of medical things going on in 2024. In addition to sort of reducing your income and deductions and credits, there's one new change that everybody needs to think about for their taxes this year, and that's a new 1099, or those things that track the income. You get a 1099 or a W-2 to account for your income every year, and they come to you and they also go to the government. You might get one of those from a place like Ticketmaster or StubHub or eBay for selling items online. In 2024, the threshold for reporting online transactions dropped from $20,000 to $5,000. So if you combine that with the increase in event prices, thanks Taylor Swift, you might receive a Ticketmaster, eBay, or some other online vendor where you made transactions. If you sold something for a loss, like maybe you bought a ticket, you decided not to use it, you had to take a loss to sell it, then you don't owe tax on that. But if you bought tickets, like those Taylor Swift tickets, and they went up in value and then you sold them and it's more than $5,000 in total transaction value, then that's reportable income on your taxes. You're going to get a 1099 for that. So don't forget that. You should always put it on your tax return, even though it might bite a little bit, because the government's going to come back and say, hey, we got this 1099 from you, you need to report it. So you don't ever want to not report income. So just be mindful if you sold tickets last year or if you sold something else online for a lot of money, you're going to want to make sure that gets handled properly on your taxes. All right, so let's shift gears a little bit and talk about some of those longer term strategies. This is where you can turn the dial a little bit each year with some deductions and some credits, but these are the kinds of things that you can do to actually significantly impact your taxes over the long term. So the first category of these things I kind of bucket as controlling your taxable income. And whether you own a business or you're a highly compensated employee or an executive, you should try to control your taxable income. Controlling your taxable income every year allows you to smooth out the years with those unusually high income there's usually higher income years that result in higher taxes. Here's a few ways that you can think about doing that. So the first would be tax loss harvesting. You might be thinking, but markets were up a lot last year. However, it's unlikely that every single one of your investments increased in value throughout all of last year. So you should be selling losers in your investment portfolios, especially in your taxable investment portfolios, to realize losses throughout the year so you can use those losses to offset other capital gains. Even if your total returns for the year are positive, you should be able to offset a lot of your gains by tax loss harvesting and controlling what that capital gains line is every year. So that should be something that you do every year, not just a year when you have big losses. Bunching your charitable deductions. So if you normally give to charity every year, consider giving less in one year and then substantially more in the next, especially if bunching your donations would allow you to give more than that standard deduction, so around $28,000. So if you're thinking, hey, I give $15,000 a year somewhere, instead of giving them a donation this year and next year, think about saying, hey, what I'm going to do is wait till next year. I'm going to give you $30,000 next year, or over 2 years, so that I can deduct that on my taxes. And you don't necessarily, by the way, have to push it out an entire calendar year. We think, oh man, we're missing a whole year. It might just be moving it from December the 15th to like January the 5th to get across the new year deadline. So you might not actually be pushing your gift out a full year, but you can push it into the next tax year, give one big gift, and then perhaps save some money on taxes that way. So think about bunching your charitable deductions. Controlling your business income. So if you're a partner or if you're an outright owner of a business, you might be able to influence whether your business pays income, realizes expenses, sells assets. So managing your income alongside your outside, managing your business income, the income that's coming off your investment accounts, all that stuff can help you lower your long-term effective tax rate and avoid spikes that lead to really high tax rates in some years. And then you've already paid those taxes, you can never get them back, and then lower taxes in other years. What you want to do is have a sort of a lower tax rate for longer, not have these big spiky years where you get into those top tax brackets. So control your business income if you have the ability to do that. And then the other thing is to watch out for net investment income tax, or NIT. If your modified adjusted gross income is above $250,000 if you're married, or $200,000 if you're single, you might be exposed to the net investment income surtax. That's 3.8% for last year. That also includes income from S corps for business owners if you aren't meeting the kind of active involvement thresholds. If you're running the business every day, then you're okay. But if you've got some S corps out there that you're not actively engaged in, then that can qualify for NIT as well. And really, if you're way over the threshold, there's not a whole lot you can do about it, right? You just have to pay the extra 3.8%. But if your MAGI, your modified adjusted gross income, is right around that $250,000 threshold, then you want to make sure you get down below it. So we want to do things to control your income to get you down below that. So that's controlling your income and some things that you can do to control your taxable income. Let's talk about retirement account strategies to reduce your taxes. We often recommend that clients have both Roth and traditional retirement accounts, and you should look to fund those Roth accounts when your income is relatively low, and your traditional accounts when your income is relatively high, when those deductions are the most valuable. So if you take a current deduction and you pay a higher rate down the road just because you got all those deductions in the past, that's not actually usually beneficial. You're going to end up paying more taxes long term. So like all deductions, IRA deductions phase out as income grows. So you want to talk about retirement account contributions with your advisor on a regular basis. This is one area that you should not sort of set and forget and just sort of max everything out every year. You want to be proactive about moving contributions between the Roths, between IRAs, between traditional accounts, between 401ks to optimize your tax picture on an annual basis. Another thing about retirement accounts that you might not think about is if you are a business owner or if you're self-employed, remember that you can contribute to your retirement account as both an employer and the employee. So you think about that, $30,000 or so in employee contributions that you can put in. You can put those in as a business owner, but you can also make the matching contribution on the other side of that. So the sum total of that might allow you to defer upwards of $60,000 of income in some situations. So 401k is still really good solutions for business owners, allows you to defer potentially a lot of taxable income. Just keep in mind that you can defer income as both the employer and the employee in those situations. And then lastly, real estate strategies Lastly, real estate strategies to reduce your taxes. Real estate can be a really powerful tool to reduce your taxable income over the long term, whether you're a business owner or an individual investor. And it's even more true if you're married and one spouse can work full time in the business and qualify as a real estate professional. That allows deductions from depreciation, mortgage interest, maintenance costs, management fees, all that stuff you do on that real estate asset to offset other ordinary income that you're earning. So you can also participate in real estate in 1031 exchanges. You can do that in other assets too, but it's really common in the real estate space. It's easier to do. That allows you to defer capital gains taxes when you sell property. And instead of having to pay those capital gains taxes, as long as you reinvest the proceeds in a similar property, then you're good to go. And you can defer those capital gains taxes for years and years and years at a time. So it lets you keep growing your real estate investment portfolio without those immediate capital gains hits. Benefit from the kind of time value of money of compounding there. Again, it's key here that somebody meets the qualifications as a real estate professional for you to really get a lot of tax benefit here. So I think it's really important you think about that, especially if you're married. And you also need to be able to focus on individual properties. So this isn't just sort of buying a REIT in your brokerage account, but you got to focus on individual properties or private funds where you're going to be able to take those depreciation and expense benefits to offset your taxes. So those are a few strategies that you can use. You start thinking about those this year, start implementing those this year for the long term. And then so let's shift gears a little bit. So this year is a little bit unique because we've got some big tax changes potentially coming down the pike. So I wanted to talk about those a little bit. The Trump Tax Cuts and Jobs Act, or the TCJA from 2017, expires at the end of this year. You've heard probably talk about that in the media. And so there's potentially substantial tax policy changes that are coming for next year. And so there might be things you need to do this year to get ready for those to kick in next year, depending on what happens. In 2017, during his first presidency, Trump passed the Tax Cuts and Jobs Act. That bill, if you remember, increased the standard deviation. It eliminated a lot of those deductions. We talked about that earlier. And it simplified tax preparation and kind of lowered taxes across the board. So all that was good stuff. But if those existing tax cuts are not extended this year, it would essentially amount to the largest year-over-year tax increase for Americans in history. So despite all the arguing, my view is kind of that the majority of those 2017 tax cuts are going to be extended going forward. No Democrat or Republican, no matter how fiscally conservative they are, wants to be responsible for that kind of effective tax increase. So I think you will see a lot of them get extended, and we'll talk about some different things in a minute. But before we do that, I want to look at some recent data, and I think you'll see why a tax hike on sort of any group doesn't make a whole lot of sense. And anytime I talk about tax policy, I like to ground everyone in what happens in reality. And that's hard to do because you're not going to get that on sort of the evening news. So here's 3 charts that might help you understand how taxes work today in America. So first, it's clear that we have a spending problem, not a revenue or a tax problem. So this goes back to why we really shouldn't let the tax cuts expire and raise taxes. You can see on the chart, going back in the 1950s, taxes have been pretty consistently about 17% of GDP. And that green line, like I said, it's been pretty steady over time. The red line is government spending, and that's ballooned up in recent years. So that should be closer to 17 to 18%. We should be able to run something close to a balanced budget. And instead, we've been spending north of 22% and creating a big deficit and debt problem. So regardless of your politics, the line that has changed recently is the spending line. It is not the revenue line. The revenue line's been pretty constant. Second, taxes are mostly paid by rich people. I know, shocker. The top quintile, or the top 20% of income earners, is literally the only group that pays a higher percentage of the taxes than their share of income. They are the only group that, by definition, actually pays their fair share by the numbers. You can see on the chart, the middle quintile makes $83,100 a year. They earn 14% of all the income, but they only pay 9% of the taxes. So if the system was totally fair to everybody, they would pay 14% of the taxes, but they do not. So you can clearly see the lower your income, the lower your share of taxes. That's called a progressive tax code. That's what we have in the US. That means the highest income earners pay the most in taxes. That's not a bad thing. You can see on the chart, the highest income earners earn 55% of the income, but they pay 69%. So more than 2/3 of all the total taxes they get paid. So they pay more than their share of income taxes. So you can make a political statement and say they should pay more. But you need to define what more means, because the wealthiest people in the US already pay more than their fair share of taxes. So it's not logically sound to say the rich or billionaires don't pay their fair share of taxes. They objectively pay more than their fair share of taxes. If you're going to say that they should pay more, that's a fine argument to make, but you got to define what that is. The other popular argument I hear about taxes is that rich people, quote unquote, which is also hard to define. I think the definition, by the way, of rich people is basically everyone who's not me. And when you say that, it's like, oh, those other rich people. But those folks pay a lower effective tax rate than their secretary. That's the famous sort of Warren Buffett example. That's the other popular argument that we hear. Contrary to what you hear on the news, the top quintile pays a higher average tax rate than all of the other quintiles. And you can see on the chart, as your income moves higher, your average tax rate goes up. The other point I'll make here, since it gets a lot of airtime, is the top 1%. I didn't break that out on this chart, but if I broke out the top 1% here, it wouldn't look any different. They pay more of the taxes than their income would dictate. Their tax rates go higher than any other group in the top quintile. So there's not any funny business going on at the very sort of tip top of the chart. Just for fun, I ran the numbers on what it would take to balance the federal deficit if we just only increase taxes on the top 5%. Why not just do that, right? That sounds like a good idea. Which the top 5% right now is anybody with income over $330,000. The effective tax rate on those income earners would have to be 69%. And that means a statutory rate probably close to 100% because everybody gets deductions and things like that somewhere. So it sounds good to say that we should solve our problems by increasing taxes on sort of a small number of people in those top income brackets. But there simply isn't enough money for that to be a workable situation. It won't actually resolve a problem. So now that you have a picture of who pays what, let's talk about what changes are on the table from a tax policy perspective this year. What's at risk in the negotiation for the tax package and things you should think about. Like I mentioned earlier, I expect most of the existing tax cuts to remain, although one or two might be sacrificed or adjusted to get the bill passed. And here's a few areas that I would kind of watch over the course of the year. The first is the qualified small business income deduction. This is hugely important for small business owners because it allows them to deduct 20% of their income or profits right off the top of their tax bill. So we want to watch that as a major change in the Tax Cuts and Jobs Act. We want to make sure that stays in place. The state and local tax deduction, or the SALT deduction. Right now, the cap on deducting your state and local taxes from your federal taxes is $10,000. I expect that to go higher to appease Republicans in New York and California that they're going to have to get the tax bill passed. So SALT's probably going to go up a little bit. Which is good news for folks that live in that state. If you live in other states, you probably say, man, I wish that wasn't happening. But that's just the reality of the world that we live in. The third item is the estate tax. So that limit was increased from around $5 million to the current almost $14 million per person. But if you're married, obviously you can double that. So we could see that limit move lower to try to include more families, raise more revenue. So you could see some changes on the estate tax front. And then lastly, everybody's favorite, the top marginal rate, which is currently 37%, could go back to 39%. Despite my arguments above, it's always the most politically popular way to raise a little bit of revenue because it impacts few people. So I'm more skeptical on further cuts, I think, than some people are. The president campaigned on further reductions to the corporate rate, eliminating taxes on Social Security, eliminating taxes on tips for service workers. Because we have a lot of spending hawks in the House, it would seem that those further cuts would need to be funded by spending reductions or tax increases elsewhere, especially in eliminating taxes on Social Security. It would lead to a significant reduction in revenue. And I'm not sure that, like I said, the Freedom Caucus, the deficit hawks in the Republican Party are going to like. So I'm assuming that Trump's going to get at least one of those in the bill. It would surprise me if he got all three of them. Again, revenue today is pretty consistent with historical levels. So there's not a need, just like there is a need for spending reduction, there's not necessarily a need for significant tax reductions. We just need to solve the spending problem. So as we go through the year, I'll keep you updated on how changes might impact your planning and steps you might need to take before year end. I do think this is one year where year end tax planning may be more important than usual because of changes that are coming down the code. So it may create opportunity to take advantage before the calendar flips to 2025. So just like your tax planning shouldn't be an annual hunt for deductions, tax time this year shouldn't just happen in the spring. You probably need to revisit it in the fourth quarter as we start to close out the year. So in closing, if you remember nothing else, remember that taxes are a long-term game. The most important things that you can do to reduce taxes are those long-term strategic choices that we talked about, structuring your business entities correctly, contributing to the right types of retirement accounts, evaluating those decisions regularly. That difference can add up to hundreds of thousands of dollars over many years, and that's far more than a few extra deductions for 2024, 2025. So if you have questions about tax planning, or if you have questions about integrating your tax planning with your investments because you feel like today they're not particularly talking to each other, reach out anytime. We'd be happy to talk further, and we will see you next time